Have you ever pondered the inner workings of equities? The world of investing can seem baffling with a multitude of complex terms and jargon. Equities is one such term that often perplexes those new to the financial realm. If you've heard it being discussed in business corridors, financial news networks, or wealthy dinner parties and found yourself a little lost, you're not alone. A large number of people stumble here, unsure of the intricacies that this term encompasses. It's a fundamental part of the vast universe known as finance and investing. It's crucial, it's unavoidable, and today, we're going to make it simple for you. Today, we're going to demystify this fundamental aspect of investing and finance. Equities, in the simplest of terms, are shares in the ownership of a company. They are not just pieces of paper but a tangible symbol of a claim on part of the company's assets, as well as its future earnings. The moment you make the decision to purchase an equity, you are in essence buying a fragment of a company, however small or large that fragment may be. This purchase transforms you, taking you from a mere observer into a stakeholder. As a shareholder, you now hold a distinct position within the company's structure. You are longer just an outsider, but a part owner who is directly impacted by the decisions of the company, its triumphs, and its failures. You become a shareholder, and as such, you have a stake in the company's success or failure. There are two main types of equities: common and preferred. Common equities, colloquially known as common stocks, provide their shareholders with the power to contribute to major company decisions through voting at shareholders' meetings. This includes electing the board of directors and other important issues. Another significant advantage of common stocks is the provision to receive a portion of the company's profit in the form of dividends. On the flip side, preferred equities deliver a distinct advantage to their shareholders. These shareholders are placed at a higher priority level in the company's financial structure. This superiority entitles them to a higher claim on the company's earnings and assets. This becomes crucial when a company faces bankruptcy, as during liquidation, preferred shareholders are paid off first. This means that if the company goes bankrupt, preferred shareholders get paid out before common shareholders. So, how do equities work? They act as units of ownership that are dealt in financial markets across the globe. These markets are spread all over the world, with the most prominent ones being the New York Stock Exchange, located in the heart of Wall Street, and the London Stock Exchange, nestled in the historic city of London. These exchanges are buzzing with activity, as buyers and sellers engage in the dynamic process of trading these equities. Prices of equities, or stocks as they are often referred to, can be highly volatile and change rapidly throughout the course of a trading day. The fluctuation in prices depends on the simple yet powerful law of supply and demand. The price of a stock ascends when there are more buyers than sellers, indicating high demand for the stock. On the other hand, the price descends when there are more sellers than buyers, highlighting an excess supply. This intricate dance of buying and selling is what defines the functioning of these markets. The price goes up when there are more buyers than sellers, and it goes down when there are more sellers than buyers. But why should you be interested in equities? Let me explain. The world of finance can be a labyrinth of complex terminologies and concepts, but equities simply refer to stocks or shares that represent ownership in a corporation. They come in many forms, from large-cap stocks of well-established corporations to small-cap stocks of emerging businesses. Equities are a tantalizing proposition to investors due to their potential to significant wealth. An important aspect of equities is the dual nature of their returns. They offer you the opportunity for capital appreciation, meaning your initial investment can grow over time as the company's share price increases. But that's not all. Many companies also distribute a portion of their earnings back to investors in the form of dividends, providing a steady stream of income. Investing in equities is therefore not just about putting your money and hoping for the best. It's about participating in the financial success of a company and reaping the rewards of its growth. It's about diversification and owning a small piece of many different companies, spreading out your risk. Over the long term, equities have historically provided higher returns than other types of investments. They offer the potential for growth and income in the form of price appreciation and dividends. However, equities also come with risks. It's important to understand that while they can offer substantial returns, they can also substantial threats to your investment. The prices of equities are not static. They tend to fluctuate, moving up and down on a regular basis. This volatility is influenced by a myriad of factors, which include but are not limited to company-specific news, such as earnings reports or changes in management. wider economic indicators like GDP growth or inflation rates, and the overall sentiment of the market, which is often swayed by investor psychology and the general mood towards investment trends. This roller coaster of price movements can be unnerving to investors. Despite potential high returns, there's a possibility to lose all of your investment if the company goes under. So, what are some basic tips for beginners? First and foremost, diversify your investments. Don't restrict yourself to one type of equity. Instead, explore a diverse blend to distribute your risk judiciously. This is akin to not putting all your in a single basket but arranging them carefully across different containers. Secondly, it's essential to adopt a long-term perspective. The nature of equities is such that may seem volatile in the short run, but historically they have consistently provided good returns over an extended period. Lastly, but by no means least, diligent research is paramount. Gaining insight into the company you're planning to invest in, understanding its business model, and scrutinizing its financial health is of utmost importance. Lastly, do your research. Understand the company you're investing in, its business model, and its financial health. In summary, equities are shares in a company's ownership. They exist as common and preferred. Equities are traded globally, with prices wavering based on market conditions. They offer possibilities for growth and income, but carry risks too. Key investment strategies include diversification, long-term planning, and thorough research. Equities, being volatile, require a firm understanding of market dynamics. In equities is not a gamble, but a calculated risk based on informed choices. The essence of equities is encapsulated in their potential to turn modest investments into substantial returns. Remember, understanding equities is a fundamental step in your journey as an investor. So step in, research, ready yourself, and commence your investment journey confidently.